Welcome to another episode of Economics 101 here at Rebel Economics. Today we will be talking about investing, what it is, why people do it, and some of the risks involved. Ready? Then relax, subscribe to Rebel Economics, and let's start with what is investing. In a capitalist system, there is a concept called an asset. An asset is everything that has the ability to make you money by either renting it out or it appreciating in value somehow. This is a very inclusive description because you might think, wait, is my knowledge about Super Mario Bros. An asset? Well, that depends. If you keep it inside of your head, then maybe not. But if you make a YouTube channel talking about Mario, and you manage to get paid from that channel via AdSense or sponsorships, then it is an asset. So by this definition, we all either have assets or at least have the potential to turn some of our knowledge, time, possessions, etc. into assets. Investment is exactly that process, the ability of turning something you own into something that generates some profits, be it through the appreciation of its value or you receiving some sort of wage or payment from it. When people talk about investment though, they generally mean financial investment, meaning the ability of taking liquid cash, aka money, and purchasing financial assets that are worth less today than they will be worth in the future. An example of financial investment is perhaps the purchase of a security or stock of a company. A stock is simply a legal right of ownership over a company and a certain claim to part of its profits. Owning these stocks might lead to two types of potential profits. The owner of a stock might receive the payment of dividends, meaning a payment that the company gives to its stockholder base as a way of dividing part of its profits, or an appreciation of the value of the stock that can then be sold at a higher price in the open stock market. For example, buying Apple stock at $10 and selling it at $20 and pocketing the difference. These two are the most notorious examples of financial investment, aka the ability of turning an asset, in this case liquid money, into a financial instrument that generates more money. Another form of investment could be considered defensive investment, by which an entity decides to convert cash into something that preserves its value better, be it for reasons of security or to shield their wealth from the effects of inflation that makes idle cash less valuable every year. An example of a commodity that defensive investors favor is gold, since it has been chosen for centuries as a great store of value in times of uncertainty in the market or rampant inflation. Defensive investment trades the potential earnings of standard investment for the security of knowing that their money is safe from the ever-dangerous effect of inflation. So, there we have it. Investment is a mechanism to turn money today into more money tomorrow, by lending it out to holders of capital in the hope of it appreciating or generating more revenues. I hope you enjoyed this Economics 101 episode. If you did, subscribe to Rebel Economics and check out some of these other videos on the screen right now.